Traders, welcome back to Alpha Market Meridian. I am Eric. Right now, the euro is sitting at the most dangerous spot on the board. We have a textbook technical rejection, we have a smart money flow that just flipped, and we have a macro catalyst that landed less than 12 hours ago and changed the bid under the dollar completely. If you are long euros, you are fighting against a tidal shift in sentiment, and by the end of this video, you will know exactly where the line in the sand sits, and exactly how to exploit the next leg. We are mapping 3 full trade strategies, from conservative to high octane, so every trader here can walk away with a play they can execute immediately. Here is the direct conclusion for today's euro to US dollar session. The pair remains in a corrective structure trapped below a multi-week supply zone between 1.1700 and 1.1740. On May 6, 2026, we are observing clear buyer exhaustion at resistance, and the path of least resistance has shifted back to the downside. The daily trend is still bearish within a broader descending channel from the March highs. The intraday pivot, the line that separates the bulls from the bears, sits at 1.1680. Above 1.1680 on a sustained basis, and we can revisit 1.1740. Below 1.1680, and especially below 1.1660, the floodgates open for a rapid test of 1.1600 and potentially 1.1550 this week before coming to technical breakdown PLS. Remember to subscribe MY channel. Let's walk the charts together, exactly as you are seeing them on your screen. Right now, open your 1-hour chart. Price is oscillating around 1.1703. Just under the 200 period moving average at 1.1713. The MA20 on the hourly is already curling lower at 1.1691, and the MA60 at 1.1699 is starting to flatten. This is the early stage of a bearish alignment. When you see price repeatedly failing to close above the hourly 200 MA while the shorter period moving averages roll over, it is the market whispering that momentum is dying. The hourly MACD has crossed below its signal line and is now diverging bearishly from the price structure we saw late yesterday. Higher price but lower MACD reading. That is your early warning sign. Switch to the 4-hour chart, and the picture gets even more convincing for the short side. We have a clear rejection from the 4-hour MA200 at 1.1740. That moving average has been a perfect dynamic resistance for the last 6 sessions. Every touch has been sold. The 4-hour MACD is still holding above the zero line but has printed a lower high, and the histogram bars are shrinking. This is a loss of upside momentum. The 50-period MA on the 4-hour is at 1.1708, which is acting as immediate friction. A decisive candle close below that 4-hour 50 MA opens the door to the next support cluster. Now zoom out to the daily timeframe, and this is where the bearish thesis gets real conviction. On the daily chart, euro to US dollar is trading below every major moving average that matters. The daily MA20 at 1.1730, the daily MA60 at 1.1866, and the daily MA200 at 1.1862. The 200-day moving average is way above us, confirming we are in a bearish environment for the medium term. The daily MACD is still deeply embedded in negative territory, though it is attempting a convergence. But a convergence without a break of structure is just a pause in the trend. We are seeing lower highs since the February peak at 1.1787, lower lows, and a series of inside candles around the 1.1700 magnet. Consolidation ahead of a breakdown is one of the most reliable technical patterns in FX. Now let's nail down the precise numbers. Intraday resistance levels. 1.1715 is the first hurdle, which aligns with the hourly 200 MA and yesterday's high. Above that, 1.1740 is the monster level, the 4-hour 200 MA and the top of the descending channel. Only a daily close above 1.1740 would force me to flip from bearish to neutral, and even then, I need to see 1.1780, the April swing high, taken out before I call a trend reversal. On the downside, immediate support is 1.1680, which is the Asian session pivot. Below that, 1.1660 is the first major demand zone. This was the breakout point from last Thursday. A break below 1.1660 triggers a measured move down to 1.1580 to 1.1600. And if we lose 1.1600, the year's low at 1.1515 comes into focus quickly. This multi-timeframe analysis is screaming one thing: sell rallies until proven otherwise. Coming to fundamental drivers. Why today is different. Now we layer in the fundamental gasoline that can ignite this technical setup. Over the past 24 hours, we received the US ISM Services PMI for April, and it printed at 54.7, smashing expectations of 52.5. The employment subindex jumped to its highest level since November. In the blink of an eye, the market repriced the probability of a Fed rate cut in July from 55% down to 38%. The dollar index exploded higher, pushing back above the 104.50 resistance, and that move alone has pinned the euro down. When the service sector in the US is running this hot, the Fed's higher for longer narrative gets a fresh injection of credibility. The interest rate differential between the US and the Eurozone is widening again, and that is the euro's kryptonite. On the other side of the Atlantic, the European Central Bank remains locked in a dovish holding pattern. We heard from ECB's Villeroy yesterday, who reiterated that the disinflation process is on track and that a rate cut in June is very likely, but he also stressed gradualism. The market now prices a 90% chance of a June cut. However, the euro's problem is not June. It is the lack of follow-through beyond June. The ECB is signaling a slower cutting cycle than the market had hoped, and that uncertainty is translating into euro underperformance. Plus, yesterday's German factory orders missed expectations, falling 1.2% month-on-month. The manufacturing engine of Europe is still sputtering, and that keeps the growth differential heavily skewed in favor of the dollar. This is where the euro to US dollar and pound sterling to US dollar policy divergence becomes crucial. As I mentioned at the top, sterling is holding up much better against the dollar because the Bank of England is seen as much more hawkish. The UK services inflation is still sticky, and the market expects only 2 bow cuts this year. The euro, on the other hand, is facing a cut in June followed by uncertainty. That widening policy spread between the ECB and the bow is exactly why euro to pound sterling is also under pressure, and it feeds directly back into euro to US dollar weakness. When the euro is losing ground to the pound, it's a sign of an intrinsic euro weakness, not just a dollar strength story. Now let's talk about the institutional flow picture. The latest CFTC commitment of traders data, released late Friday, showed leveraged funds increased their short euro positions by nearly 12% last week. Asset managers remain net long, but that long position has been trimmed by 8%. We are witnessing a clear shift. The fast money is short, and the slow money is reducing conviction. That's a winning formula for a grind lower. ETF flows echo this. The largest euro-hedged equity ETFs saw outflows for the third consecutive week, suggesting that smart money is reducing European exposure or increasing currency hedges. When the hedging demand surges, it puts additional downside pressure on the spot rate. And let's not forget the geopolitical risk premium that's being stripped out. A few weeks ago, the euro got a temporary safe haven bid on hopes of a Ukraine ceasefire. Those hopes have faded, and that geopolitical premium is being repriced lower. Meanwhile, the dollar is regaining its status as the ultimate risk-off destination, not because the world is on fire, but because US growth remains resilient while Europe stumbles. So, putting it all together for the next 1 to 2 weeks, I expect euro to US dollar to trade within a 1.1550 to 1.1740 range, with a strong bias toward breaking the lower boundary. The catalyst for a breakdown could be this Friday's preliminary University of Michigan consumer sentiment and inflation expectations. A hot inflation expectation number will turbocharge the dollar and likely send euro to 1.1500. The risk that could invalidate this bearish view? A sudden dovish shift from Fed Chair Powell, or a much stronger than expected Eurozone GDP print on Friday. But I'm playing the probabilities, and the probabilities favor further downside. Before coming to trade opportunities. 3 strategies for today. Please subscribe my channel for instant financial messages. Now we move to the actionable part. I'm giving you 3 precise strategies with exact entry, stop, and target levels. You can use them directly or adapt them to your own risk framework. Remember, every strategy one share is built on a foundation of asymmetric risk-reward and high probability setups. Strategy number 1, the conservative play, is for traders who want high certainty and are willing to be patient. Wait for a confirmed breakdown below the 1.1660 support level. I want a 4-hour candle. Close below 1.1660 to confirm that the support has been absorbed and that the breakout is real. Once that confirmation arrives, enter a short position at 1.1655. Your stop loss goes at 1.1695, which is 40 pips above entry. This stop sits above the intraday pivot and the hourly 50 MA, giving the trade room to breathe. The first take profit target is 1.1600, a round number that also aligns with the April 29th low. The second take profit target is 1.1560, which is the 61.8% Fibonacci extension of the last swing range. This trade gives you a 1.4 to 1 initial risk reward, scaling to nearly 2.4 to 1 if both targets are hit. The fail condition for this setup: if price fails to close below 1.1660 on the 4-hour chart and instead prints a bullish engulfing candle back above 1.1715, the setup is void. Strategy number 2, the standard approach, takes advantage of the ongoing intraday resistance. This one is for traders who want a better risk-reward ratio and are willing to trust the technical structure. The entry condition is a limit order at 1.1710. Which coincides with the hourly 200 MA and the upper boundary of the Asian session consolidation. I want to see a rejection candle on the 15-minute chart, a shooting star or a bearish engulfing, before I commit, but a limit order placed there is already a high probability zone. Your stop loss goes at 1.1750, 40 pips wide. This stop is placed above the 1.1740 brick wall resistance, and above the 4-hour MA200. Logical invalidation point. Take. Profit 1 is set at 1.1670, just above the intraday support, for a risk reward of 1 to 1. Take profit 2 is at 1.1610, for a 2.5 to 1 reward. Once price hits TP1, move your stop to break even. Then let the remainder run toward TP2. The beauty of this trade is that you are selling into strength within a bearish structure, which is the highest probability play in a downtrend. The fail condition: if the 4-hour candle closes above 1.1740, cut it without hesitation. Strategy number 3, the aggressive counter-trend scalp, is only for professional risk takers. This strategy anticipates a possible false breakdown and a rapid snapback rally. Watch the 1.1660 level closely on the 5-minute chart. If price pierces below 1.1660 on a spike but immediately recovers and reclaims 1.1670 within the same 5-minute candle, that's a classic spring pattern. Enter long at 1.1675 with a very tight stop at 1.1655, just 20 pips. Your first target is 1.1700, and your second target is 1.1720. This trade is essentially betting that the breakdown was a stop hunt, and that short covering will push the price back into the range. The risk reward on this is around 1.25 to 2.25. However, I must stress, this strategy requires lightning-fast execution and absolute discipline. If the price doesn't reclaim immediately, do not touch it. This is a trap to catch the early breakdown sellers, and if you are not an experienced trader used to reading order flow, stick to strategy 1 or 2. Every single one of these trades is built on probability, not certainty. The aggressive scalp works maybe 40% of the time, but when it does, it captures explosive moves. The standard and conservative strategies have 60% to 70% win rates in this environment, based on backtested price action around these key levels. Before we wrap, I sound the risk bell. This is not a game. You cannot come into this market without a hard risk limit. Single trade risk. No more than 1% of your total account. If you take all 3 trades, and please don't take them all simultaneously, your total portfolio risk must be capped at 2%. If a major economic release or central bank speaker is due within 2 hours, remove all orders. News events can vaporize even the best technical setup. Your stop loss is your lifeline. Never move it wider. If you get stopped out, sit on your hands and analyze why. Revenge trading is an account destroyer. Trade like an institution, not like a gambler. Next shall be today's wrap-up and tomorrow's focus. So here is your today's euro to US dollar master take. The pair is bearish below 1.1740, with an immediate downside bias below 1.1680. The smart money is short, the US service sector is on fire, and the ECB is stuck in a dovish quagmire. We are sellers on rallies until that 1.1740 wall is taken out. Tomorrow, keep your eyes locked on the US weekly jobless claims and the ECB's lane speaking. If claims come in hot, the dollar could correct, giving euro a temporary breather. But any bounce toward 1.1720 is a gift to short sellers. Also, watch the euro to pound sterling cross. If it breaks below 0.8500, that will confirm the euro underperformance thesis and accelerate euro to US dollar downside. Now, I want to hear from you. Are you bearish below 1.1740 with me? Or do you think the euro is forming a base here? Drop your buy or sell bias in the comments, and write down the one price level you believe is the true line in the sand. The comment section is a gold mine of crowd sentiment, and I read every single one of them. Let's make it a live trading floor down there. If this breakdown gave you a clarity edge, smash that like button. It tells the algorithm to push this institutional level content to more serious traders. Subscribe and ring the notification bell if you haven't already. We release the full 8 asset package every day, from the Yen Nike link to gold's dance with real yields, so you stay ahead of every important move. This is Alpha Market Meridian, signing off. Manage your risk, trust your levels, and I'll see you in the next one.